All right, so how to make money, how to actually make money off of buying stocks. All right, first of all, you are actually likely to be, we don't know for sure yet because we got to see if you actually apply the information, but you are likely to be smarter than half the world already because you are looking to further your education in the number one performing asset class in recorded human history, which is equities or stocks. Okay, now, what we must do to separate yourself from everybody else is to further your education. That's actually the first step in this step-by-step process. Let's just write that right quick. Educate yourself, okay? We're looking to buy stocks, picking your own stocks. Everything always gonna start with education. So, and I know for those of you who've been following me for a while, maybe you've seen my original How to Buy Stocks with Beginners video. That was the first step. I just want to go over it briefly for those who may be new to tuning in. And we're gonna go over we're gonna go a little bit more in depth with picking your own stocks, okay, in this video. So, education, all right? What I learned from money and wealth statistics is you always want to be in the minority. So we're not quite in the minority yet, okay? You're smarter than half the world, and only it's gonna be a minority of that half who furthers their education, okay? Um, and you consider the top 1% owns 35% of the equity of the planet, of the world. 35% of the equity belongs to the top 1%, right? That's a great minority to be in. And the bottom 90%, which is the majority, 90% of the world, at the bottom, owes, not owns, owes 73% of the debt. And who may they owe it to? Most likely the remaining top 10%. Okay? So what we're seeing, the trend we're seeing is you want to be in the minority when it comes to these money statistics and these wealth statistics. Okay? But you're already a minority, starting to educate yourself. And the next step, get your brokerage account open. Okay? I don't even know if that's worth writing down. Get your brokerage account open. I always get asked about Robinhood. Robinhood is cool. That's great. You know, like I said, I use Ameritrade and a couple others. The thing about Robinhood, that's cool if you only playing with a little bit of money, but once you start investing with some more serious bread, you want to get to some different brokerages like your Ameritrade, your Charles Schwab's, your Fidelities, those types. Okay, we'll go more depth on the benefits of different ones, but at the end of the day, understand that I can't think of a brokerage. I'm sure that there's some that exist, but there are not too many brokerages that require a minimum balance to open up the account. So you don't need any money to open up your account, all right? You can fund it whenever you're ready. So get your account open and get to educating yourself, all right? So now we're going to get more into the stock selection part of it, okay? I probably shouldn't even have wrote that, but oh well. And I went over this before, but we're going to go over it again to make sure so y'all get it. We're going to go a little more in depth. When we are picking your own stock, there are hundreds of different metrics to look at, okay? You got your price to earnings ratio, which might be the most popular. You got your price to sales, your price to book ratio, your net income, your long-term debt, total assets, current assets, your accounts, payables and receivables, your different cash flows, revenue, operating income, all of these different things, okay? There's a million ratios they come with. There's only, I'm not gonna say it's only, but the main three, especially for those of you like just starting out, the easiest one to grasp, because at the end of the day, you want to invest in a business that makes money without going into all kind of debt. After all, this is an equity market, so you don't want to be participating in the equity market buying a company that's in a bunch of debt that don't have no equity. Okay, so I'm not saying you can't find success doing these things, but that requires much more advanced knowledge and techniques. All right. So how the simplest metric to know if a business makes money or not is free cash flow. Free cash flow. Write that down. All right. And if you watch Shark Tank, I know that's not the first time you've heard that term. Free cash flow is the most difficult. It's not immutable. It's not impossible, but it's the most difficult to manipulate, because that's another thing with most of these metrics, they can be manipulated. Free cash flow is the most difficult to manipulate, but it's not. Don't think it's impossible when it ain't. Okay. The next thing you want to look for, And we want it to be positive, and we want the number to get higher and higher. All right, that's for free cash flow. The next metric is debt to equity. Okay, debt to equity. This we want to be low. It'd be nice if it's less than 1. That means they have more equity than they have debt. Okay, debt to equity ratio. That's the second metric we should look for. And then the third, this is not necessarily a metric, but just a fact. We want to look at the institutional ownership. This is one people don't talk about too much. Institutional ownership. These are your mutual funds, your hedge funds, your insurance, your banks. These are your institutions. Okay, and they play with some serious money, and they likely have access to more information than the average Joe, and they likely can interpret the privileged information that they have better than the average Joe. So we want, bare minimum, I would say, at least over 30% institutional ownership. Okay, that's not necessarily a higher to better, but you do want some type of substantial institutional ownership. And it's great when you can find it when it is kind of low, like maybe only 35-40% institutional ownership, and you can get in before other institutions get in. That'll really make the stock price go up. Okay, so these are 3, I would say, basic things to look for, but they don't even teach this as basic things. They'll tell you, I don't know what they're teaching. All right, look for these. So real life examples. I'm going to talk on the stocks that I'm documented on. There's one stock I'm documented on doing well. There's another stock I'm documented on not doing well. Okay. So first we'll talk about PayPal. All right. I have the video on my YouTube. I may have it archived though, but I'll make it available or send it to you or something like that if you need to see. But PayPal back in 2017, I was saying I like the stock for these 3 main reasons, because it had, let me write PayPal up here. PayPal. Okay, it had positive free cash flow. And let's make these lines because we're gonna go through a few stocks. All right, plus we're gonna put a plus. It had positive free cash flow that was trending upward. Okay, it had, we'll put a plus for the check marks. Maybe I should put check marks. We'll put check marks. Boom, boom. Okay. It had not negative. It had low debt to equity ratio, which is what we want. I mean, it had low debt, but I had a lot of equity. Okay, and it had substantial amount of institutional ownership. Okay, I don't remember what the exact number was, but I know it was for sure over 30%. Okay, it passed all those check marks. Another reason, I'm gonna give you some free game right quick. This is something that I should be keeping for the course, but here's a sneak peek. Another reason why I bought PayPal, one of the main reasons why I was excited, besides it passing these tests and the other things I look for, is a spin-off company. Okay, companies that spin off historically have always outperformed the market. Okay, they always outperformed. Remember, because PayPal was under eBay, and when a company spins off, it's basically saying the parent company is like, "Yo, this business is doing good. It's doing real good," and actually, it being with us still hovering over it, we're probably hindering its growth, and it's even kind of making it negative for us as well. So maybe they should spin off and do their own thing, and we continue to do our own thing. Because both the spinoff and the parent company outperform the market, but the spinoff just performs even better than the parent company. They both outperform the market, but the actual spinoff company does even better. So had that information mixed with the other things that I look for that I talk more about in the course. Some of it you can even find. You can find in my book. Everything you need to know about stocks. It passed all those checklists. I say, yo, I'm in there. Okay? I'm publicly documented talking about PayPal. I'm also publicly documented talking about not being so eager to buy Snapchat. When it first IPO, I remember the day when I think it was the day it IPO, or maybe within that same week, the price shot up and everybody and their mama was running into Snapchat and people was thinking they was smart. Yo, you need to be on these investments to get to Snapchat. Y'all see us doing this, number one. Like, yo, I know y'all not doing y'all homework because y'all haven't looked at the S1 filing, and you probably haven't looked at the S1 filing. You probably don't know what the hell a S1 filing is. But you out here giving this investment advice. Chill, all right? Snapchat. So when I looked at the S1 filing, After I seen all the hype, and when I see things going on, especially in my community, I'm like, hold on, let me make sure I don't need to check the information that's coming out there, save some people, possibly. So I look, they did not have positive free cash flow, negative as hell. So they was not making money. High debt to equity ratio, all kind of debt. All right, they had no equity. They had more debt than they had equity. And the main reason they have free cash flow is because they spend a whole lot of capital expenditures. You may not know what that is. That's something else I'll go over in the course, but the spending is ridiculous, and I think it was actually increasing over time and increasing faster than the actual sales. So I'm not saying like when are you even going to be free cash flow positive. Now, I still think to this day they're still not free cash flow positive. All right, and also institutional ownership was low. And I think it was, if it was at least less than 40%, but it may even been less than 30%. So I'm like, yo, if the big money ain't in there, why? In conjunction with this, yo, y'all might want to chill. I'm not going to say the stock can never do good later on in the future, or even 10 years from now. Maybe in the year, I think it IPO'd in 2017, so maybe by the year 2027, it is a good investment. But what I'm saying is you could wait to get it at an even better price instead of breaking your neck to go get it now. And so I'm right. I was right. Okay, because guess what? It IPO'd at like what, $26, I think, and then it shot up, so people was buying for $30, $40 a share that same day, and then it tanked, and it got to a point where it became less than $5 a share. Snapchat was less than $5 a share a while ago, not too long ago. I think today is like $16 a share. So congratulations if you bought it then, because now you tripled your money. Congratulations. All right. I still am not gonna mess with Snapchat because all these things still apply. I'm not saying about the institutional ownership, but I know they still got high debt and they ain't free cash flow positive. PayPal, at the time when I was talking about it, I believe it was like $50, $60 a share when I was actually talking about it. And now it's like, and the price actually dropped recently, but I think it's like $110 a share. So at the very least, it doubled. Okay, since I've been on public record talking about it, and I got it a little bit before that. So that was the lowest point for Snapchat, was less than $5 a share if you would have been patient, which I personally still wouldn't do it. But yo, come on, man, that's not a bad risk for reward at that point, because it was in penny stock land. I'm pretty sure Snapchat wouldn't have remained a penny stock forever. So that actually was a good investment for those of you who did that at that time. You showed great patience. All right, now we'll get into something current though. We're gonna talk about Beyond Meat. Okay. Beyond Meat. If y'all did y'all homework, then y'all probably already know where I'm gonna go with it. If not, it's very simple. Okay? Are they free cash flow positive? No, they are not. Do they have healthy debt to equity ratios? No, they do not. They have more debt than they have equity. Do they have a lot of institutional ownership? I don't know that offhand, actually. But they already failed 2 of the 3. They already failed 2 of the 3. And another reason why I'm not going to mess with it is because right now it's July 31st, 2019. Okay? When the stock is up like 500% or something crazy. I'm not going to, and it only been out for what, 3-4 months? I'm not going to invest in no company that then went up over 400-500%, that does not have positive free cash flow and has all kind of debt. I'm not gonna do that. It's just not smart. Now, well, I don't want to say it's not smart. It just doesn't fit my criteria. It doesn't mean that the stock may not go up. I don't know. It's just not my game. That's uncertain for me. That's just not how I invest. That's not how I would teach to invest. Okay, and I think anybody who finds good reason to invest in Beyond Meat is likely to have more sophisticated, advanced knowledge. And I haven't done any serious homework on Beyond Meat. I just went and I looked at these 2 numbers. I seen both of those was canceled. I ain't even bothered looking at institutional ownership at that point. All right. Also, another reason why I'm not so optimistic about Beyond Meat, just from a personal level, I think it's a shitty product. because I'm vegan and I don't think it's healthy. Because I'm against processed food, period. And if it's the whole thing is about getting away from animal products, is about health, that's just not the product for me, okay? And I've seen articles of people still getting sick from that as well. And if it gets too crazy and they get too caught up in the bottom line as opposed to the integrity of the food, and we see that this food still makes people sick, and the whole reason why people are turning vegan is to better their health. How do we think that's going to affect the stock, especially after it shot up so much off so much hype of it being healthy and a great stock and all of that? You know what I'm saying? So I am not optimistic on Beyond Meat. Don't mean that it won't go up. I'm not gonna put my money on it. That's all I'm gonna say. I'm not into really giving stock tips and things like that. I just give my analysis of it. You either agree with it or you don't. If you agree with it, that doesn't mean that you're supposed to buy it. If you disagree with it, don't mean you're supposed to sell it. I'm just giving my thought process. It's up to you on how you want to deal with the information. Okay. So, like I say, there's more things we can get into in analyzing stocks. I'll go on a little bit more. I go in more in depth in my book, Everything You Need to Know About Stocks, which is on Amazon. And I also have a course that's almost done. It'll probably be done by the time you see this video, actually. So, and it'll be a link at the bottom. And I go in way more in depth, and we look at macro situations as well, because it's macroeconomics that affects individual stock prices. That's going to be 70-80%. 70-80% has to do with the macro conditions as opposed to the company itself. Okay, and we go into that information as well in the course. All right, and remember, like I said, you want to be in a minority when you are dealing with money. Less than 15% of people read books regularly. Less than 15%. Okay, and that's crazy when today we're in an information age of technology keeps updating our lives. Information becomes irrelevant faster, much faster than it used to. Information that was given out in maybe the 1800s probably could last well into the 1900s. But now, there's information that came out 10, 15 years ago that we can't apply now. 10, 15 years ago, they said the technology sector was too risky to invest in, and that was speculation. But that's been like one of the best performing sectors. You know what I'm saying? Things change. Cryptocurrency didn't happen recently. Like, things change too fast. Okay, so the last thing you want to do is have outdated information, especially dealing with your finances. So, be in the minority, get the book, and then be even more in the minority and get the course, because less than 1% of people will purchase a course to, edify and educate them financially. All right? So we just want to make sure we got the most up-to-date information. Stay in the minority when it comes to getting this money. Remember these three things: free cash flow, debt to equity, institutional ownership. That alone is going to that could filter out a lot of bullshit for you, okay? That'll filter out a lot of bullshit for you. Remember, stock's number one performing asset class in recorded human history. Learn how to perfect that and get those returns even higher, and you win there, man. So, freedomoverfailure.com, okay, if you want to learn more. I have links to the book and the course in the description. Other books you should get outside of me. It's a book by William O'Neill. I think it's called How to Buy Stocks or something like that. And a book by Joel Greenblatt named The Little Book That Beats the Market. Those are two pretty simple reads. There's another book called The Intelligent Investor and One Up on Wall Street. Those are good books too. One Up on Wall Street is pretty simple. Intelligent Investor can get a tad more technical and whatnot. But mine's the William O'Neill book and the Joel Greenblatt book. Those are real simple books, and they shouldn't be too expensive either. I know mine's not. You get mine for $20 including shipping. So that's it, man. Freedom over failure. I'll check y'all on the next one.